We're here to talk about the Silicon Valley real estate market analytically from July 6, 2024, then followed up with the Greater Bay Area, which is 5 regions, 13 counties. We'll go over this slide after we finish Silicon Valley. I'm Richard Calhoun, real estate broker with Creekside Realty, working with buyers or sellers here in Silicon Valley. Please consider liking and subscribing to the YouTube. Here is a summary of the first key data points we're going to be going over. There's 5 leading indicators and then 1 metric of high interest. So inventory, what this is doing is going back over the last quarter. That's inclusive, so it's 14 weeks, 13 weeks plus both end caps, which gives you the 14. So you can see the blue is where the cool market would be. The gray is where you'd expect the market to be. The purple is where the market actually is, and the red is a hot marketplace. And this is where we were a quarter ago. This is where we are now, which is where we'll focus. So inventory is still less than you would expect, because you'd expect it to be up to on this gray line. It's less than you would expect, which tends to favor the seller, which is why it's on the red side. Now doing the same thing with the offers are now below the least you'd expect, so that's clearly favoring the buyers, but we've had a low inventory now for a long period of time, and we're only seeing 80%, 81% of the gray line. So we're missing 20% of the marketplace. Now we're moving on to days of unsold inventory. This is the supply-demand balance. And you can see that is just about normal, but it's a little bit on the blue side. So you can see that you're 6% slower than normal, because a high DUI is a slower marketplace. Then moving on to days on marketplace, this is still the 75th percentile. You can see the gray line right here. So we're almost right where you'd expect the market to be. So the speed is just a tad faster because it's on the red side of the gray line. And the market also has very little room to improve, which is why the red and the gray line is so close together. The market has a long way to slow down, which is why the gray and the blue line is so far apart. Then ask price reductions are greater than they typically are, because if they were normal, they'd be on the gray line again. They're on the blue side of the gray line. So that means we're having larger price reductions than normal. And then basically that's 9/10%. That may sound like a drop in the bucket, but that's not all the sellers take right in at 9/10% reduction. It's 15, 17% of the sellers taking more significant price reductions. And those are all leading indicators telling you where the market's going. Now, this point is not a leading indicator. In fact, it's a lagging indicator. It measures the competitiveness the buyers feel when they make their offer. The reason it's a lagging indicator is I need to get the sold price. And you can see that the overbidding magnitude is higher than it typically is, because again, the gray line is where you typically expect it to be. And up here is the hottest marketplace. So you're currently at 9.4% overbid. So if someone's asking $1 million, they're going in 1,094,000, and that's 2.6% higher than it normally is. The normal number would be about 6.8 if I'm doing my math real quick. To basically take 9.4 and subtract off the overage of 2.6. Now we'll look at the first 3 together over time. So now we're going back to 2014. Each bold vertical line is a year, and then each thinner line is a quarter. When we get to January 1st, 2023, we expand from this condensed horizontal spacing to this more expanded horizontal spacing, and that's so you can see the trend. And right off the bat, you can see DUI moves up and down quite a bit. And when a data point moves up and down quite a bit, and all of them are moving up and down quite a bit, inventory moves up and down, offers moves up and down, and as a result, DUI moves up and down. That makes it difficult to see trends. And you look at this and you almost see with a weekly fluctuation, just add more data. I'm already doing a 5-week moving average, and that was the most stable. And then you also have to take into consideration things like inventory right now in the purple line. Look how far this dropped off. That's because of the holiday. Yes, last weekend was surprisingly a holiday impact, but the listing inventory got impacted this week, which is what you would expect, because sellers are busy doing other things. Sellers assume buyers are out of town. This is not the weekend that you wanted to go on the marketplace. Neither was last weekend, because a lot of people turned the midweek holiday into a whole week holiday and were gone for last weekend as well. but that wasn't reflected in a corresponding drop last week. In fact, last week was up a little bit, but typically with a late in the week holiday, you would have seen a rush to the market just before the holiday. So I would have expected that, but basically the buyers were gone, and now we had the typical drop in inventory. Moving on to offers, offers are flat. I would anticipate that next week we'll see a drop in the offers simply because of this drop in availability. And then DUI is actually slower than it typically is, and it's improved a little bit this last week because of decreasing in DUI. And the reason the DUI decreased is this huge drop in inventory. So without this huge drop in inventory, DUI would have probably continued in this upward trend, which is what I expect to see when we have reasonable data the second weekend after the holiday. Now we're looking at days on market. And one of the things that's noteworthy on this graph that, I hadn't observed before is when you come down here to the 50 percentile and to the left, so lower percentiles, basically the data doesn't move very much. And I'm currently measuring it here at the 75th percentile, and I'm not really been happy with the performance. I have been doing a lot of research offline. I've now ruled out anything as high as 92.5% is too far up on the graph because it bounces too much. So I'm going to redistribute the data points and focus them on the 75 to 90 range. And I haven't figured out exactly how I'm going to distribute those data points yet, but this graph will be changing. It's going to take me a long time to actually do it. There's a fair amount of work, but I'm still working on it. And that will get us in this range where there's more movement, because down here you can't see shifts in the marketplace. Anyway, we start off a year ago on this blue dotted dashed line down here. Currently is the purple dotted dashed line. So you can see that we're currently taking longer days on to sell properties. Basically, you'd come out to something like the 75th percentile and say a year ago, you were down here, and I don't know what that number is, but it's probably somewhere around 18, and now you're up here with a number something closer to 21, 22. The days for the long typical seller, 3 out of 4 sellers sell their home quicker than this, but that time frame is expanded this year over last. And each one of these is a distribution. This is the worst weekly distribution we ever had, and this is the best. We start off moving a month at a time, but a month is actually 4 or 5 weeks. Here we go. You can see the boulder line right there moving. And now we're slowing down for the end of the year, slow down. That's the slowest we got on January the 3rd. Now you got the spring run up, and now you're basically at the peak of the marketplace all through here. The absolute peak of the marketplace is probably that line right there. Now you can see you started cooling down a little bit. You're still pretty close to the peak. Now you're going to start seeing fairly significant jumps down week to week to week. So we're definitely past the peak. Every indication I am seeing is the peak of this year's market was about April 19th, April 26th. So again, now the purple line is the current line where we are right now. And a year ago, we were here. A week ago, you were on the green line. Now moving on to ask price reductions. This is how much the sellers are reducing their own ask price. And I'm a little puzzled by the amount of fluctuation in this curve, because each one of these vertical lines is a data point. So there's a data point here at 2.5%, 5%, 7.5%, 10%, 12%. It's not behaved real well. You can see that the dotted dashed lines, the older lines, are well behaved. You can see the dotted lines are well behaved, but recent lines are all over the place, and I'm not sure what the significance of that is. It's poorly behaved data, in my opinion. But the big key away, again, the purple data dashed line is this year on there for reference. The blue data dashed line is where we were a year ago, which is where we're starting off. And then we're going to do the same thing a month at a time. And then at 13 weeks, we jump to weekly data. In this case, price reductions, sellers are taking more price reductions. So the market's slower this year, and the sellers are taking bigger price reductions than they were a year ago. So clearly the market isn't where it was a year ago. Now you can see you're slowing down, and that's the bottom. Now you're already improving. And here you're getting basically the top plateau for several weeks. That's probably the absolute peak. Now you're coming on the downside, and now you're starting to have fairly big steps. And some weeks are big, some are small. And we're definitely into the weekly data. But you can see the steps each week right now are pretty significant. Moving on to overbidding, this is how much the buyers are coming in. This is the buyer competitiveness. And again, it's the same concept. This purple dotted line on this slide is only on here for references, which is where we are today. The blue dashed line is where we were a year ago. And unlike the previous two metrics, here the buyers are actually overbidding more. Why are the buyers overbidding more when the frequency of price reductions is up and when the marketing time is up? I believe it's related to the history of the buyers. A year ago, they had just come off one of the biggest slowdowns in the market and the biggest price corrections we saw in a very short period of time. It was a very steep and very large price reduction, basically starting as early as Valentine's Day of 2023. Most people would probably argue and say May or April, but that's what the nice thing of this data is. And then it lasted all the way through probably January of last year, 2023. Anytime there's a big negative impact on the real estate market like that, buyers are more hesitant to overbid by a large amount. They'll overbid just as frequently, but they're more restrained on the magnitude. Now that's in the rearview mirror. And so with the same or actually worse market conditions, buyers are actually overbidding more. And we'll step through and see the level plateau last year. Now you'll start seeing the fall down. Right there is the first major step. There's another big step. And now the next one right there, 5 months ago on January 31st was the bottom of the marketplace. And you're coming up and now you're basically at the peak of the plateau on the 19th, and you're going to stay there for several weeks. And I would argue right now you're starting to move away on the 17th of May. And now you're clearly moving down and away and some bigger steps. Again, the reason this is a later date, because I think May 17th is what I said, is because escrows take 4 to 6 weeks to close. And that's about the time frame lag we're seeing. If the market peaked somewhere around April 19th to April 26th, and somewhere around May 17th was the peak of the overbidding, those two corresponding more or less if you delete the 4 to 6 weeks for escrows to close. It's on the short side, which actually makes sense to me because buyers, when they're in really overbidding, are also going in for the shorter escrows, which would be the shorter delay. Now we're looking at the inventory over time. Here you have the red line, which is the least inventory you'd expect. The gray line is where you'd expect the market to be, and the blue line is the most inventory you'd expect. The purple is obviously the current data. What I would do is point out right off the bat is look at the little decrease here that's in the data. So this little decrease is what you expect for July 4th. Look at the amount of decrease we had this year for July the 4th. This decrease is much more than you would have expected on July the 4th. I would have expected a decrease. You can see it every year in the data if we come back. Well, actually, 1, 2. So right here in 2022, you couldn't see it because the market was slowing down. I would argue that you can see a little bit here. So basically, yeah, I would expect it. It appears to be there for most years, but the magnitude of this decrease is far bigger, which is sort of what I was saying earlier, is it appears with the holiday being in the middle of the week, maybe combined with more flexible work schedules, combined with people having restricted their travel, July 4th seemed to be a bigger holiday event this year than it typically is. Here's inventory compared to normal. So now you take out just the gray line and stretch it out. You drop the red and blue line, substitute it with shading just to indicate cooler, because this would not be a straight line. It would be very jagged, and I have not wasted the computer time to generate that jaggedness. So I just put in a box to show the direction of a cool market and the direction of a hot marketplace. And so we haven't had limited inventory, and with the major reduction in inventory, you're now going more into the seller's hot marketplace. Here's the offers. So it's this reverse of the equation. We were starting to pull away from the blue line a little bit and get a little bit more normal which is way up here on the sort of the gray black line. But now we're down here. We picked up a little bit of offers last week compared to where the normal trend would be, but you're in the annual decline for the year. So the annual decline is basically you're down until basically right at the end of August and beginning of September, because this is going to be October 1st here. And then you make it Halloween basically, and then you plummet down in your level of offers. So here is where we compare to the 10-year. And basically you can see that even though it went down a little bit, so even though in the previous slide right here, it looks like it's improving, my computer, and I'm having a hard time believing it, says that it actually got worse, which would be fewer offers. So it got closer to the red blue line. I don't see that, folks, but I guess it's the distance away from the gray line. The distance from the gray line, the week after July the 4th went up, and this is pretty flat, so it did get further away. Okay, and that's why this is down. That's why I do these two different graphs, is your visual reading of one may not correspond with the visual reading of the other, and then you have to see which one's correct. So even though the number of offers went up a little bit, it was a drop compared to where they normally go. And that's because buyers took off last weekend too, which they normally don't do. I don't think they know, historically we've taken off the week before July the 4th. Moving on to days of unsold inventory. Now you can see the days of unsold inventory is going down, which is an improving marketplace. And that's basically triggered by the lack of inventory, because days of unsold inventory is basically a ratio of inventory over offers. And if inventory dropped dramatically, that's going to come up here. Now, if your offers increased dramatically, that would even have this drop even more. If your offers decrease dramatically along with the inventory, then it would actually be flat. So it's inventory driven decrease in DUI. This is a fluctuation for the holiday. This is not the market crashing. This is DUI of Silicon Valley compared to typical. So you can see the market actually got hotter this last week. And again, that's because of the lack of inventory, the bigger drop in inventory compared to normal. Here's now marketing time. So this is an easier number for a lot of consumers to understand. It's just what the long-term typical seller is taking to sell. You can see it's very close to the gray line. It went horizontal instead of up, but we're down here at somewhere around 17 days, I would call that, to sell your home. So 3/4 of the sellers are selling in 17 days or less. You can see that just a week ago it was down there at 14 days. So you picked up 3 days in basically probably 2 weeks. Here it is compared to normal. So you were slowing down. Now you actually went the other direction this last week. And again, that's the same you look at this slide and it makes sense because you're now further away from the gray line because there's more vertical separation. And that's why there's now more vertical separation. You're further away from the normal. Here's price reductions, basically no price reductions, this gray horizontal line up here. You can see in the hotter marketplaces, and actually in 2022 at the very beginning and back in 2017 at the tail end or beginning of 2018, actually, sellers on average were raising their ask price. Very unusual. You can see typically there's a price reduction. The most price reductions is down here on the blue. You can see that we got a little closer to the gray this time because the gray is coming down and the purple is pretty horizontal. So we got closer to the gray by this little uptick. And basically what this is doing is taking the gray line on the previous slide, and well, in this slide, I pulled out the 100% because it's such a predominant number. I brought the hot market shading down a little bit below, so small price reductions is still a hot marketplace. And we're in a cool marketplace because sellers are taking about a 1.4% price reduction on average. This is the frequency of those price reductions. So you can see that something around 14% of the sellers, maybe even about 14% of the sellers are taking price reductions. So that means 86% of the sellers are coming on the market and selling without ever adjusting their price. And you can see it's pretty close to normal. Here it is again, pulled out straight, that gray line, and you can see the little adjustment this last week. Here's the overbid magnitude. So the purple, you can see that it's coming down fairly dramatically in the last couple of weeks. So, and you can clearly see the peak happen back here sometime, but the peak in the market conditions would be actually about 4 weeks earlier than this. I'm doing it a little bit on the short side based on the people that tend to overbid the most tend to close escrows quicker. So, maybe it's only a 3-week delay, but I'm using a 4-week in that 4 to 6 week cycle. So again, we're clearly on the downward cycle. Buyers are feeling less need to overbid by huge dollar amounts or huge percentages, but they're still overbidding by 5.5%. So that's not insignificant. Here you can see compared to normal. So now you're getting closer to normal. The frequency of overbidding, you can see the frequency is coming down. You're getting close to a normal marketplace. Right now, you're about 74% of the buyers are overbidding. The normal would be about 72%. Getting pretty close, a little bit more overbidding is favoring the seller, which is why it's on the pink side of the gray line. And it was close enough that you're sort of in a balanced marketplace area. Here's the long-term price appreciation for Silicon Valley. You can see you're at $1.7 million. The blue is just my best estimate of what the rate of appreciation, and this is on log paper. This is your estimated monthly payments. This would be for the 10 percentile, the typical median home, and the most expensive. It assumes a Freddie Mac 30-year fixed rate at the national average, which this week I believe was 6.95. Here's looking at the same compoted in Silicon Valley, but the 3 counties: San Mateo County in the orange, Alameda County in the gray, and Santa Clara County in the blue. You can see Santa Clara County and Alameda County are typically pretty close together, especially before the pandemic. Right now, Santa Clara County has less inventory than Alameda County. San Mateo County is about normal and lower because of the smaller size geographically and population than Alameda and Santa Clara. Offers accepted are going to have roughly the same ratio, but in San Mateo County, I would argue, except for the last 2 years, offers is below where you'd typically expect it to be. Alameda County is probably below. Santa Clara County is getting somewhat close, but it's also below. The last couple years were pretty big. For some reason, this is only going back to 2019. I'll look into that and try to correct that for next week. Here's your days of unsold inventory. You can see Santa Clara County has the fastest marketplace. San Mateo County now is in second, and Alameda County has the slowest marketplace. And at least last week, that would have been pretty unusual. And I think we'll find the same unusual pattern this week. Time will tell, where the overbidding was the most in Alameda County, even though it was the slowest marketplace. Here's time on the market. Santa Clara County has the fastest long typical seller. Alameda County is second, and very close on its tail is San Mateo County. And it's still very reasonable. There were 25 and 24 days, if I'm reading the graph correctly. So to sell all your stuff in 3.5 weeks or 3/4 of your inventory in 3.5 weeks is pretty reasonable. Here's the magnitude of seller price reductions. San Mateo County is doing the most price reductions, followed by Alameda County at just about 1%. Santa Clara County has the least decrease at 0.6%. Here's the frequency of those decreases. Santa Clara County has the least common decreasing at about 13%. San Mateo County and Alameda County are right together at somewhere around 16 and 16.5%. I'd call it 16% for San Mateo and 16.5% for Alameda. Here's the overbidding. So just like I was sort of alluding to, Alameda County has the highest overbidding at about 109% or 9% overbidding, followed by Santa Clara County at about 7% and San Mateo County in last place at about 6.75%. So even though Alameda County had the slowest pace marketplace, it's got the highest amount of overbidding. Here's the frequency of overbidding, and the frequency in Alameda and Santa Clara County are the same. And again, that's pretty unusual because Santa Clara County had the fastest marketplace and Alameda County had the slowest, but yet the buyers are feeling compelled to overbid at the same rate, and San Mateo County has the least amount of overbidding at 68%. Here's the long-term appreciation. Santa Clara County has the highest rate of appreciation. San Mateo County was in second, but now it's been coming down pretty rapidly and is actually in third. And Alameda County is a little bit better at about 82% appreciation. And San Mateo County would be about 79% appreciation. You can come back horizontally and you can see that San Mateo County is now below their previous peak again. Santa Clara County is essentially right at its previous peak, and Alameda County is a little bit below. Here's the estimated payments for each county. Alameda County is clearly the most affordable, followed by Santa Clara. The least affordable is San Mateo. They are getting closer together. You can see they did cross at one point back here where it was actually more affordable to buy in San Mateo County than Santa Clara County. Here's what we're going to be going over now. These are my heat maps. The first two are white in color, which means they really don't tell you much about the market. And the reason they don't tell you individually is because here you can see inventory is red, basically, so that's lack of inventory. But the offers are also blue, which is lack of offers. So now it becomes a question of the ratio between the lack of offers and lack of inventory. And that you see up in typically in your DUI. So you got some areas that are hotter, some areas that are really cool, and a lot of areas that are white. White would mean you basically have the same normal pace. Then just days on sold inventory now, the 75th percentile, the price adjustments, magnitude and frequency, overbidding, magnitude and frequency. These now are orange in color because they're lagging indicators because that 4 to 6 week period to close. The appreciation, the sold price. I have the 10 percentile, the median, and the 90. Most people just follow the median. This helps you sandwich the price areas, and then you have your payments. So let's get into each individual heat map. Here's your active inventory. The redder the color, the less inventory you have compared to normal. The bluer the color, basically the San Mateo County coast, indicates you have more inventory than normal. And then if you're anywhere near normal, which is from 87.5 to 112.5% of normal, I consider that to be normal and white. And that would be things like North San Mateo County, Redwood City. Looking at offers, now you clearly see that this is blue in color, which again is a lack of offers. Yes, one area has a little bit of pink, Cupertino, Sunnyvale, because it's at 17.6% above, and anything over 12.5% starts getting to have some shade of pink. A couple of the areas are white, but the vast majority of the areas up and down the Silicon Valley are blue, which indicates a lack of offers, lack of activity. Here's your DUI, so this should be the ratio. You can see your hot spot is basically Mountain View, Cupertino, Sunnyvale, as well as Saratoga, Los Gatos, which is a little unusual because that's normally a slow marketplace. Redwood City has joined us in a slow marketplace, but you can see you're around 150% for a good part of San Mateo County. That means that you have a lot slower marketplace, a lot less offers for the inventory. Here's your days on sold inventory. So the San Mateo, the Bay Cities is hot, but your Redwood City through the coast is actually fairly cool. It's showing blue in the expensive areas at 88, almost 89 days. Anything over 78 is starting to be a shade of blue. So the redder the color, the hotter the marketplace, bluer the color, the cooler the marketplace. And basically from 6 to 11 weeks is a normal marketplace. Here's the 75th percentile. This is the time for the long typical seller to sell. You can see most of the areas are under 3 weeks. You got some areas like the coast, which are at 56. You got Oakland at 34. You got North San Mateo at 29. But the vast majority of these are 3 weeks or less, which is clearly a fairly fast market. You can see there's clearly hot spots, say in Fremont. You can see there's cooler spots in the middle of San Jose, Santa Clara, Campbell areas. Here's your ask price adjustments. Again, here they're sort of where you expect, which is why their coloring is fairly mild in coloring. You can see it's blue along the coast. You can see it's red up here in Fremont. You got to pay attention because the blue here is the bay, not the market conditions. Here's the frequency of ask price. So even though Saratoga Los Gatos was red in color, the frequency of those price adjustments is more common. So they may be reducing their price to get the offers to come in. And the coast is by far the most common, with 37% of the sellers adjusting their asking price. So that's over a third. It's almost 40%. Here's the magnitude of those adjustments. And this is for overbidding. So this is flipping over and seeing what the buyers are doing on their offers. So the redder the color, the higher the overbidding. You can see the expensive areas in the coast are very little overbidding. You can see that Cupertino, Sunnyvale, you can even see the island of Alameda at 21% is probably the highest amount of overbidding. So overbidding still happens. Livermore out here it's 4% overbids. So overbids clearly still happen out there, and they're higher than you typically would expect. Here's the frequency of overbidding, widespread overbidding. The only areas that are below 50% are the expensive areas in San Mateo County and the San Mateo County coast. South County has got an honorable mention at 55%, but every other area is well over 50% of the sellers are getting over their asking price. A lot of these areas are in the high 60s, low 70s, but then you also have areas up here that are 86%, 88%. 81%, 80%, 80%. So a lot of overbidding still happening, even though the market's slowing down. Here's the appreciation rate. Here, the redder the color is the more appreciation. My takeaway on here is basically COVID has allowed people to commute out further. Now, there is one notable exception, and I think it's just a fluke, but right now the appreciation calculated based on the median sold price is very high in the expensive areas in Menlo Park, Atherton. I think that means it's a fairly small number of transactions. I think just high-end properties happened to sell this last week, because I think even last week that number was blue in color. So here's your sold price, and you can see your median sold price in the expensive areas is almost $6 million. So I think this number jumped. I think it's just a statistical fluctuation. The more blue colors, the more affordable outlying areas. The red colors are your more expensive areas. And we're doing the tables at the end because I was losing a lot of viewers on the tables. The big takeaway here now is we're the 8th slowest volume year out of the last 10, the 23rd slowest out of the last 25. Here's the actual numbers, either for the whole Silicon Valley, for Santa Clara County individually, San Mateo individually, or Alameda individually. We have been talking about Silicon Valley real estate market analytics on July 6th, and then we will do Greater Bay Area. And if you type in the blue YouTube archive, you get to the YouTube presentation. If you want shorter typing, you type in the green, which I call my root URL. To get to the live presentation Saturday morning, type in the green root URL plus 2024. To get the handout H 2024 0706, and it is up. I try to get it up 15 minutes earlier. And let me break out and see if anyone's got any questions for me. So no questions. Now we're leaving the Silicon Valley and we're going to talk about the Greater Bay Area. Here is going into the Greater Bay Area, which is 5 regions, 13 counties. So region 1 is Silicon Valley. Region 2 is the city of San Francisco and Marin. North Bay has 4 counties. I don't map, but I do put in the data for the 9 Bay Area counties because the media talks about it. Then we have the Central Valley, San Joaquin and Sacramento, and Central Coast, Monterey and Santa Cruz. You can see inventory is down, probably down most noticeably in the Central Valley. You come back and historically pick some number around 46, 4,700. Even in the years in the pandemic, it was around 4,000. Now you come down and you're only at 2,500. North Bay is very similar. Silicon Valley is probably not as down as shortage as the Central Valley is on inventory, because you can see Central Valley and Silicon Valley have roughly the same level of inventory. And historically, Central Valley, the yellow, would have been significantly higher than Silicon Valley on the purple. Both Central Coast and San Mateo County are down, but down not nearly the same magnitude as the others, especially if you do it on a count volume versus a percentage, and a percentage would make the most sense. Moving on to offers. Silicon Valley has the most offers by quite a bit. It typically is at the top, but it's typically right along even with the Central Valley. So the Central Valley has more inventory relative than Silicon Valley and has less offers. Clearly, the Central Valley is not in a inventory restricted situation, and I would actually say even Silicon Valley is not. But offers are down. Offers are about the same level for San Mateo County if you come across, and pretty close for Santa Cruz. So they're doing okay as far as the volume of offers. Days of unsold inventory, you can see Silicon Valley is the fastest, you can see that San Mateo County has dropped dramatically in just the last 5 weeks, maybe. I mean, a little while ago, you were almost at 60 days of unsold inventory, and now you're below 40. You probably went from something like 56, 57, 58, somewhere up around there, down to some number around 36 or 35, maybe even. So it's been a pretty dramatic drop. You can see all the regions are dropping, which means the days of unsold inventory is getting faster. The market's actually picking up. Here's the marketing time. So even though the market's getting faster as far as the turnover rate of the new listings coming on the market, essentially, the time to sell is actually increasing in every area except potentially it's come down potentially in the cities in the last week. It's hard to tell because you can't really read where it was back here, but it's lower now, so you don't know how far the drop is. North Bay is up. The blue Central Coast is up. The orange, the cities, is basically down a little bit. The Central Valley, the yellow, is up, and Silicon Valley, the purple, is up. So everybody is taking longer to sell them their properties. Now you're looking at the ask price reductions done by the seller. You can see the trend is down, and the trend has become significantly downward in the cities and in the Central Coast in the last couple of weeks, but it's down in all the areas, almost all of second quarter. That means sellers are taking larger or more frequent, or a combination of larger and more frequent price reductions. The reductions are still not huge. You know, Silicon Valley and Central Valley, you're talking about essentially 1%. North Bay, you're talking about 1.5%. And Central Coast and the cities, you're talking about a 2% price reduction. Now, that makes it sound like a very small number, but when only, less than 20%, typically the sellers are making a price adjustment, that's a 10% price adjustment on average for those making the adjustments. Here's the frequency of those ask price reductions, and you can see the highest frequency is in the Central Valley at 28%, but then you have the North Bay and the Central Coast at about 26%. The cities is just barely at 21%, and Silicon Valley is somewhere around 14%. So clearly a little higher than the 20% I used for 3 of the areas, right at the 20% for the cities, and less than the 20% for the Silicon Valley. Here's the magnitude of overbidding. This shows the buyers, how competitive the buyers feel that they must be. You can see the cities and Silicon Valley are very close together, basically 8% overbids, then followed by the North Bay at about 1.5% overbid, then followed by the Central Valley at 0.5%, and the Central Coast is essentially getting exactly their asking prices. The frequency is pretty good in all the areas. The lowest frequency is 42% in the Central Coast, somewhere around 48% in the Central Valley. Now your North Bay is just over 50, probably 51%. The cities is probably 62%, and the Silicon Valley is probably 73%. So basically from 42% to 73%, fairly good. Basically half to 3/4 of the sellers are getting more than their asking price, or call it half to 2/3. Here's the total appreciation. The cities has the least amount of appreciation at only 46% appreciation, followed by the North Bay at about 68%, and then it jumps, and you have 3 pretty close together between, somewhere around, say, 91% and 97%. So you have 3 areas which is just shy of doubling your money. If it was plotted at 200, it would be doubling your money. Here's the sold price, and you can see that Silicon Valley and the cities are very close together on their median. Alameda County pulls down the city's price, and I guess I'd have to look and see. Marin and San Francisco are probably fairly close together. Central Coast is sort of in the middle and plodding along. North Bay is second most affordable at somewhere around $800,000 median price, and the Central Valley is around $550,000 for a median sold price. Here's the payments associated with that. So Central Valley starts off at about $4,400 a month. The North Bay is next at about $6,300 a month. Central Coast is probably coming in around $9,250. And the cities and Silicon Valley are very close together at about 13,100. And that assumes a 30-year fixed mortgage using the Freddie Mac rate, which was 6.95%. With that, we've gone over this slide already. I'll see if anyone's got any questions. Not seeing any unmuted mics. Thanks for joining. Take care. Bye for now.